Hello and welcome to Gold and Silver Assets. I'm Diora and it's Sunday the 16th of January 2022. Almost a year ago, I presented a video called Financial Absurdities, pointing out some of the flaws in fundamental analysis. For the sake of balance, I thought it would be important to discuss some of the flaws of technical analysis. I think it's important to discuss this because there is a tendency for people to assign some kind of mystical power to charts and indicators. And this is really unrealistic. Let's start with some scenarios that we've all experienced. So here's a chart where someone bought their stock down here at the bottom and price, let's say it tripled over here. And it seems to have hit some resistance, kind of matching with this over here. So the question is, what do you do? Now, let's say this guy sells the lot. You can probably guess what happens next. The price has rocketed higher. And even though this guy made a profit, he'll be most upset at not participating in these additional massive gains. Now, at that point, he's probably thinking, oh, I wish I'd held on, or I wish I'd bought more. But you can't think like that. If he had held on for dear life, let's say, then this probably would have happened. A frustrating sideways grind in price. And if he had bought more, then this probably would have happened. Even worse. The point here is that the chart is not a crystal ball. It does not accurately or precisely predict future price movements. Some look at chart patterns, and I did speak a bit about this in my video back at the end of January 2021. So take a look at that if you haven't seen it already. But I came across this Dilbert cartoon, which does have some truth in it here. So this is called Lessons in Investing. So the boss says, you should buy a stock whenever the chart looks like a squirrel sitting on a clown's shoulder. That's called technical analysis. And the employee says, I'm not going to do that. And then the boss says, good, because it doesn't work if everyone does it. Chart patterns can be useful, but they're not perfect, and it's really important to remember that. In fact, there's a guy called Thomas Bulkowski, and he's got his own website, and he's studied this extensively, and he's actually documented the success rates of a whole range of different chart patterns. And the thing you'll note is that there's not one single pattern that's 100% reliable. Classic texts show examples like this. So we've got this chart here, and here we have a classic head and shoulders top over here. And this is the other shoulder here. This is the neckline. And so price breaks below that neckline here, and it comes down and hits the target, which is this green line over here. So this target is calculated by using the height of this pattern over here. So looking at that, that looks pretty good, doesn't it? It looks pretty easy to do. But what's not often commented on is the example of failure as shown here. So this is someone on Reddit who's posted a whole bunch of amusing yet very honest examples of chart pattern outcomes. Here's the S&P 500 in July 2009, and this is just after the big crash that happened over here. This was the very bottom. And if we look over here, to me, this looks like a head and shoulders top, doesn't it? It looks like that classic example. You've got the neckline over here, and price is just broken down below that neckline. So wouldn't it be reasonable to expect price to drop to at least over here, which is about 800 here, based on that pattern? And of course, you know, it looks like there's a bit of support in that kind of area. Looking back, well, here's what actually happened. It did the exact opposite, and it shot upwards. So basically that chart pattern was actually very misleading. It wasn't at all useful. In fact, price didn't really drop below once it broke that neckline. It just kept going up. What about triangles? So over here, someone's drawn this thing here, which is a bullish triangle. Now, looking at this, I get the impression that this was drawn retrospectively. I mean, if you're looking prospectively, you might have kind of drawn a steeper upper line that kind of went through here maybe. And so this could be called a breakout and a retest before moving up. So that's one of the other things you've got to be careful of, is that often people show amazing results, but they're actually produced retrospectively. You do have to watch these things prospectively. Now, anyway, when price broke out, it hit the target nicely, and then that was the end of the move. But over here, you can see the reality, and you know, this can happen too, and you've got to remember that. Looking at a real life example, so to me this looks like a perfect bullish triangle, doesn't it? And here we've got a nice green candle, so price is closed definitely outside of that triangle there. So to me that looks like a buy signal, doesn't it? Well, let's see what happened. Oh, again, just not reliable. And here we move on to a common favourite with people. They just love this one. This is the cup and handle pattern, which is spoken of quite a lot. And look, it is generally a bullish pattern, but remember, it's not 100% perfect. So over here, we've got this example here. We've got this cup. It is slightly lopsided. And then this here is the handle. And this stock is bought at the breakout from the handle, so it would have been bought over here. And of course, then price proceeded to move upwards and actually exceeded the target. But of course, the reality isn't always like this. We've got to remember that. This result is not a dead cert. And so here's what our Reddit poster has drawn there. And a real life example, let's use the GDX. Now, I think you'll agree that this looks pretty similar to that classic example that I showed in the last slide here. So you've got this curve here. This looks like a handle, doesn't it? And then, yeah, I haven't drawn it perfectly, but yeah. So the breakout looks like it occurred over here, and price is proceeding to move upwards quite nicely here. And in fact, it's actually made a new high. So, yeah, is this promising? Is this going to rocket up? Well, of course, we all know what happened. Ouch. That pattern failed, and actually failed quite dramatically, as you can see over here. So overall, look, I'm not saying chart patterns are not useful. I'm saying they're not 100% reliable, and probabilities do have to be taken into account. The other aspect of chart patterns is that they are subjective. Two people can look at the same chart and each see a different pattern. Another tool in technical analysis is the use of indicators, and there are hundreds of indicators available out there. Some of them are free, some of them are available for a price. And overall, you can group them into four main types. So trend indicators tell us about the strength and direction of the trend. And so an example of this is the moving average. Momentum indicators tell us about the speed and strength of price movement. Examples of this are the RSI or the stochastics. And with these indicators, what you're looking for is divergence between price and momentum to signal a trend change. Volatility indicators tell us about the rate of price movement, but the thing is it does ignore direction. So examples of these are Bollinger Bands or average true range, or ATR for short. Volume indicators are thought to tell us about the strength of a trend. So examples are the Chaikin oscillator or on balance volume, OBV for short. Strong trends are thought to often occur in association with large volumes. Indicators may also be classified as leading or lagging, but personally I haven't actually come across an indicator that I consider to be reliably leading. Now, maybe I've missed something here, but let me know if you know of one. But the ones that I've tested out prospectively, I haven't really found anything. Just as an aside, now this is more of a signal rather than an indicator, but I just thought I'd include it here when we were talking about leading signals and indicators, and it just seems useful to me. So this chart shows the 10-year yield for US Treasuries minus the 2-year yield. And what you can see here is that, so when it goes to below zero, that's effectively a yield curve inversion. Now notice how the yield curve has inverted in advance of recession. So the recessions are shown by these shaded lines over here. Even going back here, you've got an inversion that occurred here and here. And I think when people have tested this over even longer time periods, it's been well over 90% predictive here. So to me, this looks interesting as a kind of something that you look for to make you aware of a potential recession coming. The problem is that the time from the signal to the recession is unreliable. So here it was relatively short, whereas back here it was much longer. And so, you know, that's what I mean by flaws. You know, someone might have said this, oh, a recession's coming, and, you know, it could be like 3 years before it comes, and people say, oh, you don't know what you're talking about, oh, it's wrong. But that's why you've got to understand exactly its usefulness and its flaws here. So the flaw here is the timing. Okay, going back to indicators, when using them, it's really important to understand the function of each one that you use. You should also understand the flaws, and don't delude yourself. They all have flaws. Keeping it simple also helps. So, for example, using multiple indicators that have the same function won't be very productive, and it will just clog up your charts. The advantage of keeping it simple is that it avoids things like this. What a mess. When I see charts like this, I think it's a reflection of the person's mind. Just one big confused jumble, I'm afraid. If your chart starts to resemble a Jackson Pollock painting, you might have a problem. In conclusion, technical analysis is often perceived to be an objective thing, but I found it to be actually quite subjective, and I've demonstrated some examples here today. It would be a big mistake to expect it to be perfect, and precision cannot be expected. Some might say, oh, what's the point of it? Doesn't it make it useless? No, I don't think it's useless. While neither fundamental nor technical analysis are perfect, both have their uses as well. And there's no right or wrong form of analysis. I think we each have to pick and choose the tools that work best for us. Personally, I use a bit of both and incorporate probability and risk management to try and allow for some of those flaws. Next up, the market update. Well, Groundhog Day yet again. Gold and silver are pretty much the same price as when I spoke to you last week. So I've thrown a few different things together this week just to mix things up a little bit. So we will still look at gold. This time we'll look on the monthly scale. I think whenever we look on the daily scale, obviously not much is happening. So we need to zoom out a little bit and get a bit of perspective here. So this chart I've put on the log scale, and what I've done is join this low and this low over here. You can see here it just barely poked below that, but that's just a wick. It didn't really close below that. But yeah, another option if you wanted to would be just to join these two lows here instead. But anyway, I've done this just because here this looks like it's being supported in some way in this area here. And obviously now remember, this candle isn't complete because we're only halfway through the month. Okay, so just bear that in mind. But to me, again, this doesn't look disastrous. Nothing's broken at this stage here. So this is obviously the line that we want to keep an eye on. And as we've seen in previous weeks, when we look at gold price in world currencies, again, it's actually looking pretty good, actually much better than this chart here. And as you know, I'm bullish on this. I think this is still in a bull market here. We are in an uptrend and nothing's changed as far as that's concerned. Obviously, the question is, do we go poke down before we move upwards here? The other interesting thing I was looking at was the duration, because if we're looking at symmetry, I mean, there does seem to be some kind of symmetry here, if we call this roughly the midline. Now, of course, it's not perfect here, but if we look here from here to here, before it began to make its big move downwards, this was 14 months here of consolidation. Right now, we've exceeded that. We're at 17 months now. And so, yeah, this is going on a lot longer than many of us expected here. But this also means it's coiling up. So whatever move it makes, it's likely to be pretty strong and pretty large. Yeah, okay. So next we'll look at that parabola theory. So as many of you know, those who've been following every week, I've got this theory that gold price is in a parabola. Now, I've lost access to the software to be able to do the overlays onto the gold chart itself, and I don't know how to put this onto TradingView. But basically, what I've done here is mark the major lows and then use Excel here in this case to plot a best fit line, and this is a pretty good fit. And at the moment we're still on this line. We haven't broken down. There's been no breakage of this theory yet. And so looking forward, so I've put the calculations in here, and these are the numbers we're looking at. So again, nothing's broken at the moment in terms of the parabolic potential here as well. So obviously, ideally, we want to stay above 1800 from here on. If we do break below that, then we're going to have to redo this best fit line. We obviously redid it once, and we may need to redo it again. And that's one of the flaws of this, because you don't know where the next low is. Retrospectively, it's really easy, but prospectively, not so much. Yeah, last week I got a scolding for not, well, apparently I was told that I'd conveniently omitted to discuss this theory. Anyway, here it is. I'm not going to be discussing every single thing and, you know, tell you every time I'm right, every time I'm wrong. That'll just get really boring, you know. Anyway, Yeah, I do. Every week there's always someone who wants to give me a scolding. Oh dear, oh dear. Those are usually those types who need to have a gold star and a pat on the head. You know, that's school kid indoctrination, I'm afraid. Yeah. Either that or people just like to bully others. There's definitely a lot of bullying going around at the moment. But yeah, I won't be bullied. What I do like is when people come up with different ideas, and I don't have a problem with people disagreeing with me. I just want to hear their thoughts. And we had luckily the majority of you do come up with interesting thoughts and ideas. So last week we had someone talk about options expiration dates and whether there's any kind of relationship with price movements. And I mean, yeah, I guess as we going forwards, it kind of felt like that, hasn't it? People always talk about price changes after expiration. And so I thought, look, let's have a look at this. So what I've done here, now there's two sets of lines here. We've got these blue lines here, which are the monthly expiration dates. And then these yellow lines, orange lines, are the quarterly expiration dates. And so I've put it on this weekly gold price scale here. Now, obviously, all I can do is eyeball this. Ideally, what you want to do is get an objective measure of this by plugging in all the raw data and doing the analysis like that to see if there's anything significant. But obviously, I don't have the raw data and to do that really. So I completely put my hands up and admit this isn't perfect analysis here. But so just eyeballing it. If we start with the little blue lines, if we go back to here, so options expired here, price went up, options expired here, price went down. And then we got another down, kind of sideways, and then this went up a lot, up again. So it's kind of, and so it goes on. If you look at it yourself, you'll see there's not really any pattern that I can see anyway. And in terms of the monthly, so that's these orange lines, again, nothing obvious there. So let's look at this one here. Obviously, price went down a lot after that expiration, but then after this one, it went up a lot as well. So again, nothing much. And I thought, oh, maybe if we look over a longer time scale here. So this is just the monthly, the quarterly expirations. Going all the way back to 2000, but again, there's just no obvious real kind of pattern that I can see there. So I'm not sure if that's what you meant for me to look at, and obviously if someone's got anything to add to that and whether I'm looking at this in the wrong way, then do let me know. But yeah, so far can't see anything obvious there. And everyone's talking about the Federal Reserve and tapering and so on. And so in terms of reducing asset purchases, I mean, they've announced reducing minimum asset purchases for the last 3 Fed meetings, haven't they? And this line looks pretty straight to me. I'm not seeing any dips like this. It's not doing this, is it? So remember, they're talking about minimum purchases. That doesn't mean that they're going to reduce the purchases. They're not the same thing. So at the moment, absolutely no sign of tapering in terms of asset purchases. US dollar. So this is the DXY on the weekly scale. And remember, ages ago, we'd joined this low here. And we had 2 options because we got a kind of a wick down here. So you can either join it to this low or this low. And when you do that, you can see that it's predictive of some support and resistance areas here. And what happened here, we went back into that area. And so I suggested that we're probably going to faff around through there before it makes a decision on direction here. Last week, we dropped just below that, but then actually price closed back into this channel over here, And so I think we're still going to spend potentially a bit more time in there. What you're looking for is a close either above or below this channel. I think if we go below, which I think is likely at some point, I mean, it may be that we go up here a little bit longer before we do that. If we do drop below this though, then I think we're headed towards the 88 level. And 10-year US bond yields. Now, this is on the log scale as well. And what I've done here is join these highs over here, and that results in us predicting this bounce over here. The other line I've drawn here is the 200-month moving average, which kind of seems to be pretty much following this trend line as well. So I think that's a pretty useful kind of region to be keeping a watch out for. I think any break above this is going to suggest a break in the bond market, and things could get pretty crazy. But as long as we're below this, then I think the range is going to be between 0 and 2.5% basically. So yeah, this is just the area to watch here. Around probably about 2.7% here is what we're watching for. Right, that's it from me. I hope you're all doing okay. All the best and see you next week. Bye.